Jay Powell gave a speech that people said was undecidedly hawkish, firmly focused on inflation, doing whatever it takes. We've heard some other hawkish talk here at this event the last couple of days. What does this mean for your central bank? What kind of pressure does it potentially put on the ECB to step up with a hawkish message too?
I'm usually quite skeptical about distinction between doves and hawks. I would say that the Jackson Hole meeting this time reflected pragmatism and reality. And the reality is that we have excessively high inflation globally, also in Europe, and that's largely now caused by the war in Ukraine, Russia's illegal, brutal war in Ukraine, and the subsequent energy crisis we are suffering from. That's why it's action time, and our mandate is price stability, and we will work accordingly.
Action time. Does that mean step on the gas? Does it mean accelerate, speed up a bit?
It means that we will have to take into account the excessively high inflation, which is clearly exceeding our target. It's largely energy inflation, roughly half, but it's spreading to the rest of the economy. And that's why it's important that we act now, and we will contain inflation expectations rising so that we can keep them anchored. In fact, we started our normalization of monetary policy already in December, and we are continuing consistent and orderly monetary policy consolidation, monetary policy normalization.
If you see signs, however, that these price pressures may be spreading, broadening out, the worst fear of an inflation, or one of the worst fears of a central banker, is that these inflation moves start getting entrenched. Are you concerned about that? And would that be another reason to say maybe we have to get a little more aggressive?
We are concerned about it becoming entrenched, although I have to say that there is a difference, or actually some differences between the United States and the euro area for the moment. I name just three. One is there is stronger demand in the United States because of fiscal policy. Second, the energy component is more complicated for Europe, obviously, because we are dependent on imported energy. And third, the labor market is red hot in the United States, and wage increases have been clearly much higher than in Europe. But we are seeing also wages increase understandably in Europe. And now it's important that we maintain the anchor, which is relatively moderate wage inflation, and we will contain inflation expectations becoming de-anchored.
Where do you stand or sit right now on the question of 50 or 75 basis points on that September meeting? Do you see more pressure there, or maybe not just more pressure, but maybe more need to do something like that, or at least consider it?
We raised rates in July by 50 basis points. The next step will be a significant move in September, depending on the incoming data on the economic and inflation outlook.
What would be the number one thing to tilt your position to say, well, maybe it's time to go for 75?
I think it's important not to jump the gun, and let's see the figures in September. We will get the next economic projection exercise in front of us prior to the meeting, and we will have the latest incoming data in September. Then we will see. As I said, we have clearly excessively high inflation in Europe now, and this means that according to our mandate, which is price stability, we have to act now. And the monetary policy is now facing the dilemma of, on one hand, maintaining inflation expectations anchored, and on the other hand, avoiding that we will push the economy unnecessarily to a recession because of monetary policy. There are other reasons we may have to face a recession, but not monetary policy.
What would those other reasons be?
Clearly, that we are we have a severe energy crisis in Europe, and this is reflected in the availability and price of electricity, gas, other forms of energy in Europe, and it is quite likely that the Eurozone economy is slowing down. It's slowing down as we speak, and the risk of recession has also increased.
How worried about recession now, and is it something that makes it complicated to try to deal with inflation that's still rising on the headline anyway, at a time when the recession may not happen. Maybe there'll be a miracle with energy somehow in the bad winter everyone's expecting, and you won't get that kind of slowdown. But how do you navigate that? How do you weight those decisions now?
I think it's usually better not to believe in miracles, and unfortunately we have to be prepared for a protracted confrontation between the West and Russia. And this means that this energy crisis or the reduction of availability and increase of price of fossil fuels from Russia is a long-standing phenomenon, and this will mean a serious cut in the purchasing power of our citizens, and it is also going to be a boost for investing in renewables and the green transition in the energy economy.
In terms of the exchange rate, I want to come back to this hawkish stance now from the Fed, because we know that they're big. They carry a lot of weight in the world. They affect markets, and they certainly affect currencies. So how does that then bring the exchange rate potentially into the decision? And when we've seen the euro touch parity, is that some kind of level, some kind of measure that when that happens, then you might have to, in spite of a looming recession and the war in Ukraine continuing, that you might have to consider being more aggressive and even a bigger rate hike?
We referred to this factor already in July in our monetary policy statement, where there is a reference to the exchange rate as one reason why we took a decision on a larger rate hike than earlier expected. Certainly we are monitoring the exchange rate. It's not our target, but the exchange rate is indirectly influencing inflation, especially because it's making the energy imports more expensive. So this indirect channel is important. We are monitoring it, and we will look at that as well as one indicator when we take the decision on the rates next time in our September meeting.